Sup Money Masters, lovely to see you. In today's video we are preparing a little checklist in final preparation to kick off our money mastering journey. Or even if you have started that, these are things that we need to remind ourselves about on a regular basis so that we destroy any excuses we may have to either start or continue our process. Let's rock and roll. My question today is, are you ready? Are you prepared to kick off your journey or make some adjustments perhaps if you are on your money mastering journey? I am going to share some things with you today, a little checklist, things to remind yourself of, and most of these things are things that you need to hear rather than what you want to hear. I apologize up front. Let's kick that off. The first thing you need to know or remind yourself of is past performance is not an indication of future performance. You cannot base your expectations on the past performance of the stock or unit trust or mutual fund or ETF you've invested in or do want to invest in. Just because something performed a certain way in the past does not mean it will continue exactly the same way into the future. Also, these investment markets, stock markets, investment platforms, the unit trust or mutual fund, the ETF, they're not human. They have no emotions. We have emotions about our investments. But these markets, they don't know you. Therefore, they can't care. And the markets owe you nothing. Maybe you've been very disciplined, you've worked hard, you've started your savings plan, you've increased perhaps your earnings so that you can save, and now you want to start investing. The markets are totally emotionless, don't know you, don't care, don't expect anything from the market, expect something from yourself, and that is remaining disciplined and mastering your emotions through the process. And even if you do that, still plan for your plan not going according to plan. Yes, we have to be emotionally prepared for that. Unexpected things happen all the time, and some of these external unexpected factors have an impact on the investment markets. The US gets upset with China. People are worried about the trade relationship. Lockdowns happen. A ship gets stuck in a channel, causing supply chain problems. All of these things are unexpected, and we must plan for our plan not going according to plan. So moving swiftly along to our next point. Understand your capacity for risk versus appetite for risk. Whoo, fancy words. Easy one to explain. Let's assume you win the lottery jackpot, 100 million bucks. You decide to take 10 million of the 100 million and invest it. Your capacity for risk is high. What does that mean? If you take the 10 million and even if it happens that you lose the entire 10 million, I'd like to think you're going to be quite okay with the 90 million that's left. So in this example, that 10 million you take out of the 100 million, it means your capacity to take risk with that 10 million is very high. But now, what is your appetite for risk? Even if you can take a lot of risk with the 10 million, you may already know that to protect yourself from yourself, you need to take lower risk, even if your capacity is high, because your appetite is lower and emotionally you don't want to go through this high risk process where your investment value fluctuates a lot. In this example, your capacity to take risk is high, but your appetite is lower. What is vice versa? You want to take risk. Give me the risk. I want to get the best possible return in the shortest possible time. Then your appetite is high. But if you lose this pot of money that you are willing to take this excess risk with, if that means if you lose it, you are in deep trouble. You can't lose that money. Then your capacity to take risk is low. And we have to marry capacity for risk and appetite for risk, which brings us to, you have to do what is reasonable rather than always what is rational. So in my example, if you have 100 million, you take 10 million to invest, it would be rational that your capacity is high and that you should be taking rationally a lot of risk with the 10 million, because even if you lose it, you're going to be all right with the 90 that's left. But if you don't lose it, you've taken the risk and you can get higher, much higher returns. But is it reasonable? And that brings us to the appetite for risk. We must marry capacity for risk and appetite for risk by doing what is reasonable. But even if you do what's reasonable, don't be later. Be disappointed with the returns you didn't get for the risk you didn't take. So let's say your appetite is low, your capacity for risk is high, appetite is low. You do what you believe is reasonable, taking lower risk, but your risk is so low that in 10, 15 or 20 years time, the returns from your lower risk investment did not match where you needed to get to. And now you're disappointed. You can't be then disappointed about the returns you didn't get for the risk you didn't take. So you've got to be reasonable, but reasonable can't turn out to be unreasonable. Okay. And always remember, we've mentioned this a couple of times now. Markets go down. It is a feature, not a glitch. You can't protect yourself by taking no risk. There's no such thing as no risk. And if you are going to take more medium to higher risk, you can prepare by knowing markets do go down. In fact, riskier assets, so medium to high risk, especially high risk assets, things like ETFs, stocks or shares, maybe a higher risk mutual fund or unit trust, approximately 70% of the time, those investment values trade below their previous high. What does that mean? I'll take a stock as an example. You buy a stock at $100. It goes up to 102, up to 103, up to 105. Then it comes down to 104, 103.50, 104.50, 102. In this example, about 95% of the time, the stock traded below the level of 105, its previous high. Go and check out my video on emotional biases, part C of the risk series, about anchoring, because we anchor to the 105, and we get upset when the asset price or the value is below its previous high, because we've anchored to that previous high. So I would say it's better that you, from time to time, put on clean pants when the markets go down, rather than making poor emotional decisions based on your emotions by either, let's say, stopping your regular investment process, or perhaps even selling your investments or realizing your returns when the markets are down, when you should not have done that. Rather put on a pair of clean pants than make irrational decisions. And lastly, especially if you are kicking off your journey, have you decided on the investment platform you're going to use? Or if you're on your journey, perhaps you want to consolidate everything on one platform if you haven't done so already. Have you decided which product on the platform is best suited for what you are going to save and invest for? Do you know what you are saving for, which will inform your time horizon. Because these two things here at the bottom is extremely important in determining your own personal risk profile. So, are you ready? And if you are, let's go. I wish you all the best in your journey, or if you are on the journey, if you need to make some corrections, it's going to be awesome. You're going to be a money master legend. In the next video, I am going to delve into different products or different mutual funds, unit trusts, different assets that you can invest in. I'm going to help you understand where they fit in on the risk return profile. Are these things lower risk, medium risk, or high risk investments, and why? So that you can start determining, based on your own personal risk profile, what type of asset, what type of instrument, what type of mutual fund or unit trust you can consider based on your own personal risk profile. If you enjoyed this video and it helped you, hit that like button, or you can always join the channel. You can subscribe to the channel wherever you see this icon. You can follow me on Twitter at MoneyMasterSJ on Twitter. I look forward to seeing you in the next video. Cheers!